The new year picks up right where last year left off, with COVID, the Fed, and jobs. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on the jobs numbers.
I don't think anybody can look at this labor market and this jobs report and believe that we have a sustainable degree of heat in the labor market.
Former CEA Chairman Glenn Hubbard on building bridges to save capitalism.
People's livelihoods, communities, firms, and industries can be at risk. That, too, is not a bad thing as long as we prepare people.
And David Rubenstein on the anniversary of the attack on the Capitol 1 year ago.
There are a lot of people in this country today who believe that those who stormed the Capitol were not insurrectionists, but just tourists. And as a result, I think the country is bitterly divided.
It was a whole new year this week, but in some ways it felt like an extension of 2021, with the explosion in Omicron cases continuing to set new records in the United States and, for that matter, around the world.
COVID in the environment here and in the world is probably here to stay, but COVID, as we're dealing with it now, is not here to stay.
But so far, the cases appear to be less severe, and the new mayor of New York, Eric Adams, spoke for many when he said we just need to move forward and get our lives back.
This city is going to function, we're going to be safe, and we're going to stay open.
When it comes to the Fed, we learned this week that it really means what it says about tightening monetary policy, releasing minutes from its December meeting saying that, quote, it may become warranted to increase the federal funds rate sooner or at a faster pace, and even that reducing the balance sheet may come on the heels of any rate tightening, which Michael Kontopoulos of Richard Bernstein said wasn't necessarily expected.
March is a live meeting for hikes. I think the only surprise, perhaps, was sort of the view on the balance sheet runoff.
And if we had any doubts remaining about the Fed meeting being live in March, they may have been answered when the jobs numbers came in on Friday. Disappointing on the overall number, but showing robust growth in wages of 4.7% year over year and an unemployment rate falling down to 3.9%, way below what anyone expected at this point. The markets took this eventful week as a re-rating of risk, with the S&P 500 down almost 2% for the week, its worst start to a year since 2016, while the NASDAQ was even worse, down over 4.5%. And bonds sold off, with the 10-year yield adding over 25 basis points, ending up over 1.76%. Here to explain this wild first week of the new year are Katie Koch, Goldman Sachs Global Co-Head of Fundamental Equity Funds, and Greg Peters, Co-CIO of PGIM Fixed Income. So welcome both of you to be back on Wall Street Week. Greg, I'm going to start with you because to some extent fixed income bonds really drove a lot of the week. Explain what happened here, because we did have the Fed minutes, but we were getting increased rates even before we got to the minutes.
Yeah, so the markets were skittish before the minutes, and then the minutes came out, and as you mentioned, David, it basically reaffirmed what they said before. The surprise was, though, the balance sheet runoff. I think that did take investors by surprise. But what you really experienced this week was just a re-rating of the Fed. And so you've seen Fed hikes pulled forward, more aggressive over the near term. And I think the markets didn't like that, and appropriately so. And so today's jobs report just kind of cemented the view that March is a live meeting. Now, I think it's important to go back in time, though. So March wasn't even on the table contemplated, 6 months ago, 3 months ago, and now it's a live meeting. So it really is representative of how quickly the Fed has kind of shifted gears here.
So, Katie, over to you on the equity side. Equities might have reacted violently to this. I wouldn't say they did. The main story, I thought, from the week, you correct me, on equities was what happened with tech.
Yeah, tech had a very disappointing week of performance. Let me just back up and say that we have had the worst start to equity markets since 2016, and kind of big picture, we've had this 12 years of a great environment of rates going down and markets going up, and we're all kind of getting used to a new normal. And so that's played out in the volatility that we've had, and we're now down more than 1.5% year to date on equities. As you pointed out, the locus of a lot of that pressure has been in technology. The reason for that, and people have varying levels of familiarity, so I'll just say, is that when you look at tech companies, most of the value is far out at terminal values. So when the rate curve steepens, that part of the market sells off the most. It's really raising this question for everybody who's had a lot of capital allocated to tech. Is tech over? Is this the end of tech outperformance? We don't think that's the case. We continue to have a lot of capital committed there. We appreciate there's going to be some near-term headwinds, but very long-term, even medium to long-term, we know that even the companies in the value part of the market that are leading the market now, so take banks, for example, one of the number one things that they're going to spend money on over the coming years is innovating themselves on AI, cybersecurity, moving workloads to the cloud. And so we know that all companies, regardless of whether they're value or growth, are going to be doing a lot of tech spending, and that should actually accrue to these companies over the medium to long term. So we would encourage people to look at these dislocations as opportunities to pick up exposure selectively.
So Greg, you mentioned the jobs numbers. Why don't you unpack that a little bit? What jumped out at you? One of the things that I noticed, obviously, was the increase in wages.
Absolutely. That was a clear focus from a market perspective. The headline number was disappointing, let's say, 199 new ads. But I think you have to look at the 4-month average, which is substantially higher. It's about 369. So what the market really looked at closely was the acceleration in wages. And so I will say we haven't seen those wages create kind of broader inflation pressures, but that's the worry. I think that's the classic economic worry that many have, and that's why you've seen the rhetoric really shift and get cemented around that March meeting being in play. So it's really about wages, as investors and economists in particular are worried about wages really kind of infiltrating the entire system, thereby creating broad-based inflation.
Greg, we can't talk about bonds really without talking about the yield curve. Tell us what happened with the yield curve this week, and did it tell us anything more? I mean, it did not, as I see it, flatten much more. At the same time, it already was flatter than it had been in a while.
Yeah, I was surprised. I have to be honest with you. I was expecting the curve to flatten out. It's my expectation that it will. I think the more pricing that you see in the front end, the bond market will continue to suss out and sniff out that the Fed is too aggressive here and throwing the economy into an unnecessary slowdown. So the curve has flattened a lot already. That was the story in the back half of last year. It's steepened out a touch thus far this year. There's been a real rate story because inflation expectations have also come down. So it's a little perplexing in my mind, but I do anticipate that if the market continues to pull Fed policy forward and more aggressive, I would fully anticipate the curve to flatten in here.
Katie, on the equity side, are you taking into account the extent to which wages are a substantial component in the cost structure at this point, if we're going to see increases wages continuing?
Yeah, and David, you and I have spoken about this previously, but we think this is another data point to support our view that we are having this kind of very large rotation of power, basically, from capital to labor, which I actually think is going to be long-term quite positive for the social cohesion of this country, for the growth trajectory, and from an investing perspective right now is extremely positive as it relates to the consumer, because we have a lot of pent-up consumer power. Good balance sheets, wages going up, that's good for the consumer. And so we do have a lot of capital allocated for our clients into the consumer. And in particular, we are focused on the millennial consumer, so the younger consumer, and their strong preference for experiences over things. So we like things like travel and concerts. And this data and news flow around the variant gives us opportunities actually to build into those positions, because they do sell off when we get fears around the pandemic. But we've seen this recovery because we think that preference is actually very long-term and very sustainable.
Greg, as far as we can tell, and it would be guesswork to some extent, do you think the Fed wants the wage rate increase to come down? Is that what they're doing in part with monetary policy?
I don't think so. I mean, they've talked about inequality and trying to deal with inequality, and I think that goes against that philosophy. So I really don't think that's the case. That shouldn't be the case. I think what they're worried about is this textbook situation where wages rise and therefore good prices rise. So I'm not necessarily convinced. So I actually am concerned that they're focused on the wage aspect of it, because I think it goes against this inequality story that they've been talking about. So it's a delicate balance. So it's easy to, criticize what the Fed is doing and possibly thinking, but the wage issue in my mind is an important positive development, not a negative one. And I think it's been flipped around unnecessarily.
Yeah, it's always easier to criticize when we're up in the bleachers and not down the arena, right? Thank you so much, Greg Peters and Katie Koch. They're both going to stay with us as we turn from this week in the markets to longer-term implications for investors. That's coming up next on Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Weston. Still with us are Greg Peters of PGIM Fixed Income and Katie Koch of Goldman Sachs. So, Katie, let's turn from this week to the longer term with respect to equities first, then we'll turn to Greg on fixed income. As we go into 2022, you draw an interesting distinction between disruptors and disrupted. Tell us about some of the disruptions you're looking at coming up this year for equities.
Sure. Whenever we turn the page on the calendar for a new year, we do like to do some longer term thinking about where we've come from in equity markets and where we're going. And I just think it's really interesting to know we were looking at the top 10 companies as at the beginning of 2022. And if you go back 20 years, there's actually only one that's still a top 10 company, which is Microsoft. And it's 5x over that period. The 9 others on that list have actually detracted a total of 235 billion of market cap over that period. And I think that just underscores the importance of being on the right side of disruption and picking the companies that you think are going to drive forward good fortunes in the future. We're really focused, just to end, on 3 main themes going into this year, but I actually think they're going to be relevant for investors for most of the decade. And those themes are the future of healthcare, everything from genomics to robotic surgery, the future of the planet. So this idea of transitioning to a more sustainable planet. Yes, it's about renewables, but also sustainable consumption, circular economy. We're invested in a company, for example, that recycles jeans. And then finally, we were talking about tech earlier. We're big believers that we need to invest beyond the FANGs, down the market cap and around the world, because tech power is going to get diffused out of Silicon Valley into the smaller cap part of the market, but also have many local winners around emerging markets. Take PagSeguro, for example, and a company listed in Brazil. It's a micro merchant expert in payments in Brazil. And so these are some of the themes that we think are going to matter in 2022, but well beyond for long-term oriented investors.
Those are some great macro things to keep an eye on. Greg, to come over to you, I'm going to make it simpler perhaps than it is. It looks to me for fixed income, it's really all about the Fed. And frankly, whether there might be a policy error. I mean, because now we know we're going to have some tapering of the buying, we're going to have some rate increases, and now this week we found out we're going to actually have some quantitative tightening, it looks like.
No, I completely agree. I think the fundamental risk for the markets this year, not just fixed income, but broadly speaking, is a central bank policy error. And it looks like we're careening towards that. And look, it is a very difficult environment to ascertain. That so much is clouded by COVID opening, reopening, closures, those types of things. But for us, we're looking at the fixed income market in several ways. First, from a yield perspective, with the 10-year currently, just call it at 175, that's exactly where we hit in March of last year. That was the top. I think we're getting close to the top in yield once again. So it might overshoot. So the near term is always more difficult, of course. But I think, looking out over time, at 175 10-year, we actually see value there. And we see value because we think there's a gravitational pull towards disinflation. There's a demographic issue here in the US and globally in many respects. And let's not forget, we put on a lot of debt to fight the virus. And that acts as a draw on growth. So for that reason, we're actually pretty constructive as yields kind of hit these levels here. And so we might be wrong over the near term, of course, as things have a tendency of overshooting. But I think 6 months to 12 months from now, you'll be rewarded.
So I'm going to guess, Katie, but I'm going to guess that if in fact Greg is right, that we're talking 175, it could overshoot for a time but come back down. You're going to be fine with that on the equity side.
Yeah, we should. Equity markets should be able to digest that. And just to be very clear on our outlook, while we do expect volatility, and as you mentioned at the outset, we haven't had a great start, we do actually think equity markets at Goldman Sachs Asset Management, we believe that they will outperform cash and bonds. So we do think it's the right asset class to be in. One might need to look further than the broad U.S. equity market, which has been a great thing to own for the last 12 years. That was the best thing to own in the markets. You may need to look further to that abroad, to emerging markets or small cap, but we do expect equity markets to outperform, and that yield level should be fine for equity markets.
Well, let's just pick up on that emerging markets here and go back to Greg for a moment, because Greg, I know you've thought a fair amount about what's going on with China, because China's off to a rather rocky start at the beginning of this year as well in their property market and some of the debt over there. What do you make of emerging market debt, either China or otherwise?
Yeah, so China and emerging markets broadly have been a value trap. Right. And so one of the oddities of the recovery here is that typically kind of emerging markets have a higher beta component versus developed markets. And you haven't seen that. And there's reasons behind it, of course. And so in fixed income, EM has underperformed. And so I think it might be a tad early still. But, as I look at 2022, I'm looking at emerging markets as an area for real alpha opportunity. So I think it's been a value trap for good reason, but I think it's changing and pricing's changing. And of course, it's predicated on central bank policy there as well, as you need to see inflation kind of come off the boil, but see real opportunities. And China is not what it used to be. And I think investors need to kind of get a grip around that new reality, which is China is slowing and will continue to slow. And it's just a natural kind of maturation process, right, of the economy. So it has a very different input into the global economy as a result. And I think over time, investors will continue to kind of understand what that really means.
Katie, one thing that we dealt with in 2021 and we're still dealing with today is semiconductors. And I wonder about the semiconductor sector and how you see it developing, because obviously we've had a real shortage, real supply chain problems there. It's a fairly concentrated supply system. At the same time, there's a lot of talk about huge investment in production, including in the United States.
Yeah, when we look at 2022 as a year, last year was recovery, markets up 30%. We're really focused on resilience across a lot of things as being a great investment opportunity, and the supply chain is certainly one. And semis is the most important part of it. Also very relevant to China, which Greg just spoke about. So very big picture, 12% of US GDP roughly runs through the factory floors of Taiwan, because there is one company in Taiwan that has the ability to manufacture at the leading edge of logic, which is about 5 nanometers. And I'm not going to go into too much detail, but the headline is in the US, we really can only manufacture at 10 nanometers. And that's a problem because all of the technology we've spoken about on this segment that we're so excited about, whether it's the cloud, AI, 5G, et cetera, they're chip dependent technologies. And we do not, as a country, and actually the Chinese feel the same way, want to be dependent on one public company from the perspective of the US and what many people would argue is a hot geopolitical zone for the manufacturing of our most important technologies and for a very significant portion of GDP. And so one of our big long-term positions is the reshoring of the semi supply chain to the US. And in particular, we're very positive on semi-equipment manufacturers. So I put KLA forward as an example of that. And at the same time, in China, we are also investing in this theme because we believe that they will continue to invest in semi capacity as well. So this is a story for 2022, but also well beyond 2022.
And Greg, to sort of wrap this up on the fixed income side, when you look at opportunities for 2022, with rising rates, how important is the quality of the credit you're looking at? Do you have to get pickier?
Yeah, I think this year is about differentiation and alpha creation. But I think the days of beta are gone. So most of the tightening is kind of behind us in terms of spreads. So I think it's about alpha and relative value. So we're actually pretty excited about the relative value opportunity set. And a great example is just looking at where the 20-year Treasury trades. It trades with a higher yield than the 30-year. I mean, that shouldn't happen, right? So it's just kind of emblematic of the opportunity set writ large. So we're pretty excited about the relative value more than the beta.
Thank you so much to Greg Peters of PGIM Fixed Income and to Katie Koch of Goldman Sachs. Coming up, we take a look at the week ahead on Global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to see what's coming up next week on Global Wall Street. And we start with Juliet Sally.
Thanks, David. Well, the Bank of Korea's rate decision will be a key focus for investors and could be a close call. Bloomberg Economics tips they'll hold off on a hike until February, when the impact of the Omicron variant should be clearer. We'll also hear from the world's biggest chipmaker TSMC Thursday, with investors eager for its outlook on the semiconductor crunch for the year ahead. TSMC stock just hit a 10-month high, and analysts are bullish. Goldman Sachs is forecasting even faster growth this year than in 2021. On the economic front, we have China trade data, trade and retail sales from Australia, South Korea employment data, PPI from Japan, plus inflation and trade readings from India. Now over to Danny Berger in London. Danny.
Thanks, Juliet. Well, geopolitics really will be the focus for the upcoming week in Europe, specifically that of Russia. First off, there's Russia's intervention in Kazakhstan, the protests there in the past week. How will that unfold going forward? There are also two NATO meetings, one with Ukraine, another with a Russian council, that over the Russian troop buildup on the Ukrainian border. And at the same time, Russia flow of natural gas into the rest of Europe continues to be an item to watch in the week upcoming. We've seen that be extremely low, contributing to very high energy prices. How will that flow impact the energy prices in Europe going forward? Now, elsewhere on Tuesday, we have the official new bringing in of the Bundesbank president. It was Jens Weidmann. He hands over the reins to Joachim Nagel. Again, that happens on Tuesday. Christine Lagarde of the ECB will also be in attendance. Now over to Romain Bostic in New York.
Thanks, Danny. Next week is going to be incredibly busy for market watchers. A slew of economic data that includes the all-important Consumer Price Index. 7.1%. That's what economists surveyed by Bloomberg expect the index to show in December. It would be the biggest year-over-year advance for consumer inflation in almost 4 decades, in the third straight month that the index was above 6%. Elsewhere, the Senate Banking Committee has scheduled a hearing on Tuesday to consider Jerome Powell's nomination for a second term as Federal Reserve Chair. On Thursday, that same committee will hold a confirmation hearing for Fed Governor Lael Brainard's elevation to Vice Chair. And finally, earnings season is officially kicking off next week. Keep an eye on quarterly reports from Delta Airlines, Citigroup, JP Morgan, BlackRock, and Wells Fargo. David?
Thanks to Juliet Sally, Danny Berger, and Romain Bostic. Coming up, the threat to capitalism if we don't start building bridges to a dynamic and disruptive future, instead of building walls to try to keep it away. We talk with Glenn Hubbard of the Columbia Business School about his new book, The Wall and the Bridge.
We often talk about the growth and dynamism side of capitalism. That's why we're in the game. It's hugely important. The flip side of its disruption.
This is Wall Street Week on Bloomberg. Walls. We spent much of the 90s tearing them down, whether the physical kind,
Mr. Gorbachev, tear down this wall.
Or the walls of tariffs and regulation. But then competition from foreign goods and from technologies started to hit people where it hurt, in their jobs.
Our jobs are going to Mexico. Our jobs are going to other countries. China and others are making our product. We don't make it anymore.
And so some have started building walls again. But former Columbia Business School Dean Glenn Hubbard says it's bridges to help workers adjust to change rather than walls to protect workers that we really need. In The Wall and the Bridge, Hubbard proposes a series of private and government programs to help workers build a bridge to the future. Because, in the end, even painful change is essential to capitalism, which, echoing Ken Langone, is the system that in the long run will do the most people the most good.
Which works better for everybody. And there's no doubt in my mind, capitalism.
And we're delighted to be joined now by one of our regular contributors here on Wall Street Week. He's Glenn Hubbard, former chairman of the Council of Economic Advisors, certainly of Columbia Business School, and most important for this purpose, the author of the new book, The Wall and the Bridge. Glenn, thank you so much for being back with us. It's a fascinating book, an important book. In reading through it, I have the strong sense part of your motivation was you have some concerns for the future of capitalism, because to some extent, inherent in capitalism is a dynamism and a creativity that can lead to some destructive qualities.
I think that's 100% right, David. You know, it's like a coin with two sides. Economists, policymakers, business people, we often talk about the growth and dynamism side of capitalism. That's why we're in the game. It's hugely important. The flip side of it's disruption. Many of us, frankly, most of us win from a lot of the disruptions I talk about in the book, but not everybody. And I think we have to notice those who have been left behind and figure out how do we get everybody to be able to participate in our economy. Not a new idea. It was actually Adam Smith's idea. We need to put the liberal back in neoliberalism, classical liberal, that is, a la Smith.
Let me ask you, Glenn, as an economist, does dynamic capitalism inherently lead to increasing inequality?
I don't know about that, but it certainly needs to generate churn and disruption. You know, many jobs and industries that exist today didn't exist 100 years ago. That's the good news. The flip side of that is that people's livelihoods, communities, firms, and industries can be at risk. That, too, is not a bad thing as long as we prepare people. You know, when Adam Smith talked about the wealth of nations, he talked about competition and openness, and those are good things. But I think if Smith were alive today, he would talk about the ability to compete. In the world we have with technological change and globalization, is everybody really at the starting line? I think that's the inequality that would have worried Smith and should worry us.
Glenn, in your book, there's a lot of talk about dynamism, creativity, innovation, and how important that is for a society, for growth, and for the individuals in it. At the same time, you have a distributive notion as well called mass flourishing, that you actually go back to Adam Smith and say, this was consistent with Adam Smith. Talk to us about mass flourishing.
Well, mass flourishing is more than GDP. You know, when Smith wrote The Wealth of Nations, there was no GDP, although he did talk about maximizing the size of output. I also think, though, of the Smith of the theory of moral sentiments, where he used an expression, mutual sympathy, that today we might call empathy. I think the right economic idea is everybody in the boat, everybody participating, everybody flourishing. And to the minds of the classical economists, flourishing meant participating in the economy, the ability to have meaningful work. And I think that's really what the book is about. How do you build bridges to that kind of work? A bridge either takes you to somewhere or brings you back. And taking you to could be preparing you for the jobs of today and tomorrow. And taking you back is rethinking social insurance. Do we have a way to reconnect people who fall out of the boat to the boat?
And what if you knew for a certainty that in order to have truly mass flourishing, you had to give up some of the dynamism? Would you make that trade?
I wouldn't, and that's the point of the book. I think there are a number of people that I note in the book that Adam Smith would school if he were here today that suggest that you can just sort of haircut dynamism. The real issue is compensating people who've been left behind. We have old expressions in economics. The same professor who told you that trade is good or technological advances are good, he or she also told you that's because the gainers can compensate the losers. And By compensation, what I talk about is not writing people a check or pensioning them off, but investing in getting people connected, preparing people for work, and preparing people who got left behind. That's something we used to do in the country. The land-grant colleges of the 19th century, the GI Bill of the 20th century. I suggest ways we could bring those to life today.
Your book is The Wall and the Bridge. Talk about the wall before we get to the bridge, because as you point out, we've had some people really eager to rebuild some walls, if not physical walls, and some of them are physical, then certainly walls of tariffs, walls of regulation, walls of restriction.
Well, walls are easy and seductive. They're very popular in history, be they physical walls for anti-innovation, anti-trade, anti-immigrant. They're easy to explain to people. I can make the world like it used to be. I can make it comfortable to you. There are two problems with that. One is that you're giving up on all the dynamism of openness, whether it's openness abroad or openness at home. You're giving up on competition. And the other is you can't really make the world like it used to be. So the antidote to the wall is not the kind of let it rip economics of laissez-faire or in the contemporary worlds or what neoliberal economists talk about. The real antidote is the bridge. And that really goes back to what classical liberal economists like Smith and others talked about. And bridges in today's society are about education, they're about training, but first of all, they're about noticing. They're about noticing that not everybody is in the same boat. And how do you pull that off? You know, I tell a story in the book that, to my mind, the Queen of England asked the best question in the entire financial crisis when she asked faculty at the London School of Economics, why did nobody see it coming? Why did nobody notice? I think what the Queen meant was, how could things be so important and slow moving and you didn't see it? You could ask the same thing about technological advance and globalization. We need to address these concerns. They're real, and if we don't put up bridges, we'll get walls. You know, we hear the debates about capitalism versus socialism. I don't think that's what's going on. It's really both the right and the left are serving up walls to voters and business people. We need bridges.
So let me ask the maybe provocative question, Glenn. Is it too late to build those bridges? Can we go back in and retrain people for the new economy?
It's not too late, and the stakes are going to get larger. Let me take both those in turn. We can invest in communities and people. So in the book, I talk about a modern version of place-based aid, of helping communities develop business services that are right for their areas. I also talk about a large block grant to support community colleges. Rather than talking about a free tuition movement, what about the resources to help community colleges adapt people and their skills for the jobs that are? We can do this. And the problem's about to get bigger. You know, while the book looks at technological advances in globalization of the past few decades, we're in an era in which artificial intelligence and machine learning on the one hand, and the adaptation to climate change on the other, are going to affect millions of workers in the economy. We need to get this right. It's not only not too late, it's essential to do it right now.
Glenn, how do we invest in community colleges, which, as you say, really offer a lot of potential promise, and hold them accountable at the same time? Because you and I both know some places that works well, some places it really doesn't work well. A lot of people go to those community colleges, borrow a lot of money, don't get the certificates, and really just end up with a lot of debt.
It's a great question, and the goal should not be to, quote, get people to go to community college, or for that matter, four-year college. The goal should be to get them to complete meaningful degrees. So in the book, I talk about mechanisms for funding that would restore two-year college funding to the level of funding states are providing four-year colleges, but measuring accountability by completion, by providing student services that help lead to completion and to jobs that are meaningful in local economies. So is it easy or a silver bullet? No. Is it doable? Absolutely yes. We've done these big things in America before, and we need to think bigger about doing them again.
Okay, Glenn Hubbard, thank you so very much. He's the author of this terrific, fascinating, and really important new book, The Wall and the Bridge. Of course, he's from Columbia Business School. Thank you, Glenn. Coming up, we wrap up the week, as we always do, with special contributor Larry Summers of Harvard.
Orchestrating the turning down the temperature in the economy, I think is going to be very challenging from here.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we're delighted now to be joined once again for the first time in the new year by our special contributor. He is Larry Summers of Harvard. So happy New Year, Larry. Great to have you with us. Let's start with the big news of the week, perhaps, came on Friday with those jobs numbers where people were a bit disappointed in the overall number, but there were a lot of other numbers in there that suggested we've got a pretty robust labor market.
This was a strong report. After this report, the vacancies to unemployment ratio is going to be higher than it's ever been. We saw wage growth at rates, depending on which measure you used, 7 to 8% annualized rates in the last month. And if you look at the sequence of reports, it's been accelerating. The establishment number was disappointing, but the previous months were substantially revised upwards, and I suspect this one will be as well. I don't think anybody can look at this labor market and this jobs report and believe that we have a sustainable degree of heat in the labor market. The level of heat that we have in the labor market is consistent not just with high inflation, but is consistent with accelerating inflation. And there isn't going to be a path to less inflation without a cooler labor market, and I think that has to be sobering.
So, Larry, last year, the Fed seemed to be reassured, at least for part of the year, that there was some slack in the labor market that would absorb some of that inflation. Is there any doubt in your mind right now that we're in full employment? Because we not only had these numbers, we also had the JOLTS numbers come out, and boy, we're record numbers of quits.
David, I've been doing this long enough that there's always doubt in my mind. Nothing is certain, but the probability that we are past a sustainable level of heat in the economy is higher than I can remember it at any point in the 40 years that I've been watching these things. I think that the Fed is recognizing that, and that's why they've executed in the last 3 months such a strong pivot from talk of transitory inflation and the need to ensure employment targets and the need to guard against deflation, which was their rhetoric just a few months ago, to a focus on inflation now, to accelerating the tightening, to signaling the very real and even likely possibility of rate increases in March. We are well into the adjustment of monetary policy. My own view is that the Fed and the markets are still not recognizing what's likely to be necessary. The market judgment and the Fed's judgment is that you can somehow contain this inflation without rates ever rising above 2.5% in terms of the Fed funds rate. I don't think that's very likely to turn out to be right. And if it does turn out to be right, it's only because the economy is extraordinarily vulnerable to rate increases, which will mean problems of its own. So I think we're headed into a very challenging period for the Fed in terms of executing a soft landing. It looks to me like we're going to need some meaningful deceleration in nominal wage growth, not necessarily in real wage growth, but in nominal wage growth. And if we don't have much experience of getting such decelerations in nominal wage growth without a substantial, well, at least some slowdown in the economy. So orchestrating the turning down the temperature in the economy, I think, is going to be very challenging from here.
Well, let's pick up exactly on that point, orchestrating this cooling down, because we also had a piece of news out that the market certainly reacted to this week, which is the Fed minutes from the December meeting, in which they said not only are we going to talk about tapering, we might well have rate increases more and sooner than we thought. And by the way, we might get to quantitative cutting, actually. We're going to actually tighten the quantitative easing instead of just tapering. Is that enough? And by the way, can they do all of that stuff in the time allotted?
David, they can make the choices that they want to make. Certainly, there have been periods when the Fed was raising rates 25 basis points in a given at every meeting for periods of a year or more. So it's certainly something that is technically possible. I think what we're going to find out is what the vulnerability of the economy is to rate increases. If that vulnerability is not greater than it has been historically, then it's really quite unrealistic to think that we're going to keep inflation under control with 2% rates. It may be, as some argue, that because of greater levels of debt, because asset prices are substantially inflated, the economy is more vulnerable than usual to rate increases or to quantitative tightening. So it's not an easy balance that they're going to have to strike. My guess is that we're headed into a difficult period because I don't think that inflation's likely to come down very quickly. And indeed, it's almost baked in that the annualized inflation figures are going to be rising for the next several months because of the very flattering compares or very low compares in January and February of last year. So my own sense is really of the difficulty of this, and the challenge for the Fed is that they're likely to see some amount of fluctuation in financial markets and concern about growth before they see the declines in inflation that are substantial. And then they're going to have a very difficult set of decisions to make.
So Larry, finally, we're looking forward next week to the confirmation hearings for both Lael Brainard and Jay Powell on the Fed. And we also have nominations coming up from the White House for other positions there. At the same time, we're getting new information about some of the trading in the markets by some of the existing members of the Fed. The most recent one coming out this week, actually, with respect to Rich Clarida, somebody you and I both know well. We don't know all the facts about it. You don't know it. I don't know it. But what's your reaction, basically, to the question of members of the Fed and their participation, what they should be doing, what they should not be doing, what they should be disclosing?
Look, I don't know all the facts, and it's a grave mistake to judge people based on press reports, and I'm not going to do that. I do think that it should be inconceivable that in a period of market turbulence where the Fed is contemplating major action, that a Fed official would trade in one direction and then 3 days later trade in another direction on a 7-digit scale. That should be inconceivable. Again, I don't know what happened, and I think it's important to recognize that Chairman Powell has moved aggressively to put in place new rules. And I think those new rules are really quite rigorous with respect to what the Fed does. I think we need much more rigorous rules for everyone who is serving in the federal government. We had an outrage of the week here on the show 6 weeks or so ago about trading in the House of Representatives. And I think we need to have very rigorous rules, and that's something that needs to be looked at very carefully.
Well said. Thank you so much once again for being with us as our very special contributor on Wall Street Week. He is Larry Summers of Harvard. Coming up, the day our democracy hung in the balance. This is Wall Street Week on Bloomberg. Finally, one more thought, and this time it's not from me. It's from Carlyle co-founder David Rubenstein about the events of a year ago when a mob stormed the Capitol building to stop one of the most important steps in the U.S. constitutional process, the counting of the electoral votes. His reflections.
In my lifetime, January 6th will be an important day because that is the day when we had an invasion of the Capitol, the first time it's happened since 1814 when the British invaded our country. And nobody really thought this could happen. And so it's amazing to me that it did happen. But more amazing to me is that 1 year later, we are still in the same situation. If we didn't prevent another thing by having cops or military people there today, I suspect you could have another invasion of the Capitol. There are a lot of people who really, really are upset with the way the election went against Donald Trump or the way that other things have happened. And so I do think there are a lot of people in this country today who do believe the election was stolen. There are a lot of people in this country today who believe that those who stormed the Capitol were not insurrectionists, but just tourists and not doing anything that's inappropriate. And as a result, I think the country is bitterly divided. It's not as bad as a civil war, but it's clearly a country is divided, and it's reflected in the Congress. The Congress is bitterly divided. Nothing is really getting done of any consequence because the country is really bitterly divided.
Stormed the Capitol building. They are marching.
The business community, I think, is disappointed that the country hasn't moved on. What business people like is certainty, predictability. And right now, there's a lot of uncertainty and a lack of predictability about what the federal government is going to do. So I think that the business community, by and large, wishes we had moved forward and we were not in a situation we are today. But the business community is a realistic community, and they recognize that right now, the country is fairly divided. The Congress is fairly divided. It's unlikely we're going to get major legislation one way or the other that President Biden wants. So I think the business community would like to not be involved in commenting on this. The business community wishes this was behind us, but the business community recognizes that for the foreseeable future, we're going to be living with this division in the country, and this bitter division is going to be probably increasing, not decreasing. The rule of law did prevail. There were 65 lawsuits that were filed by the people who thought the election was stolen, and 65 times the courts threw them out. So the rule of law did prevail. And the truth is that the rule of law does prevail in this country. And the truth is the military, you now know, was not prepared to overtake the government, though there were some people in the administration, I think, who wanted that to happen. But the military stayed out of it, and the rule of law did prevail. Whether it will prevail in the future, I don't know. But right now, I think the rule of law is going to prevail in the United States. And that is one thing that people around the rest of the world really admire us for, which is the rule of law does exist in this country. And despite the events of January 6th, rule of law did prevail.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.